Good morning, everybody. Thank you for attending the Place Your Trades Network Spaces. This Spaces is brought to you by TraderVate, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. You can now trade these on the DOM on TraderVate's main platform as well. They're a great way to get exposure to futures markets with limited risk. You can go to placeyourtrades.com and get the TraderVate web app for free. I also write a weekly blog and daily pre-markets overview on the markets that you can subscribe to at placeyourtrades.com. I will be doing a summary of this episode with my key takeaways that will be available for download as a PDF. So if you're interested in getting this PDF, you can click on the link in my feed or the link in the nest above, or placeyourtrades.com/spaces to sign up for it. The PDF overview will be available and emailed out to anyone who signs up. Now on to our guests. First, we have Abdulaziz. Abdulaziz is a prominent public Saudi figure on energy and climate issues and a public speaker for major energy issues for the Chamber of Commerce, municipalities, and other entities in the Middle East. For the past 15 years, Abdulaziz has been an avid observer of E&P activities in the MENA region. He reports daily on regional competitor activities in the upstream sector, as well as reporting on quarterly updates on updated business activities globally in the region, including monitoring of all oil and gas discoveries in the Middle East, North Africa, and global frontier areas. Next, we have WarrenPies, who is co-founder and strategist at 314 Research. Prior to 314 Research, Warren led Ned Davis Research, Energy and Commodity Strategy. In that role, he built the firm's commodity-related studies, models, and unique indicators. His research combines proprietary, fundamental, technical, and macro indicators to identify major investment themes and market trends affecting capital markets. Next, we have Robert Cutler. Robert is a practitioner member the Waterloo Institute for Complexity and Innovation at the University of Waterloo. He's a fellow at the Canadian Energy Research Institute, senior research fellow, Energy Security Program, NATO Association of Canada, fellow Canadian Global Affairs Institute, and senior analyst at Hill Tower Resource Advisors. He's earned 2 bachelor's degrees at MIT, a master's degree at Penn State, and a PhD at the University of Michigan. And last but not least, we have Cyril Widdershoven. Cyril is a senior analyst at Hill Tower Resource Advisors, a Middle East defense energy analyst, and worked for years in MENA. He holds a degree in Middle East war studies with a focus on oil, gas, defense, terrorism. And according to him, he's a politically incorrect Dutchman. All right, so now that we have the introductions, we're gonna go it around, and obviously, if you have any questions or comments for each other, please raise your hand and feel free to join in the conversation. So we'll start with Cyril. Cyril, the Dutch government just issued a statement that they're closing Europe's largest onshore gas field on October 1st. So first, what's the reasoning of this, and then what are the implications for this?
Okay, thank you, Tracy. The official reasons behind it is that since 2012, 2015, the region where the Groningen gas field is has been hit by earthquakes, and we are talking not about the size of earthquakes as in Syria or Turkey or Morocco, but on a Richter scale, it's earthquakes between 1.6 and 3.8. So it's a minor case of earthquakes, but the damage in the region is substantial. The second reason behind it is that the total problem of the Groningen gas field and its redistribution of revenues has been mismanaged since 25 years. So there is a large part of the Dutch society that feels that things went wrong, were not equally distributed, and on that came earthquakes. The other, and people do not want to talk about this a lot in the Netherlands. The main other reason is very simple. Our Minister of Economics and Climate and Energy, Rob Jette, and his Vice Minister, Mr. Velbrief, have promised to their voters that there will be an energy transition. And the energy transition, according to them, is, as we say in the Netherlands, gas is out. So even that we hold still the largest onshore gas reserves in Europe, the government, which is a coalition government, has decided in all of their wisdom, and governments are always smart, to close the largest onshore gas reserve of Europe at the time that Europe is looking for gas, that Europe is going through an energy transition that is not working extremely well. Germany is a prime example. We want to get rid of Russian gas, which is also not really working, and prices are extremely high. So the government, and for American listeners, we have a coalition government made of liberals, so right-wing, central Christian Democrats, and we have two very small ones, which are Protestant conservative and a small social liberal party. So it's a mix. It's not as easy as in the USA or in the UK, even that looking at how Washington is right now, I think we have it even easier. But our government has been voted out. So we decide to close Groningen at the time that in 2 months there will be new parliamentary elections, and most probably there will be another kind of government. And looking at the possible structure of that one, there could be a right-wing conservative one, which maybe could even decide, okay, whatever has been said by the former one, we will change because we will need the gas and winter is there. So at this moment, the outlook is not very good. Prices are high, are going up again. And the outcome of it all is, after that, the Dutch were in the top 3 gas exporting countries in the 1980s. We are now heavily dependent on US LNG, Qatar LNG, Norwegian gas, and yes, we are still importing Russian gas.
And being that, since we're talking about gas, I just wanted to stay on the subject for a minute. I know that EU gas storage is full right now, but but are there still challenges ahead? Are we out of the water?
I am always amazed that the whole world always looks at gas storages like at crude oil storages or SPRs. What is extremely simple at this moment, the European gas storages are almost full. The average is, I think, now 95.08% full, which is extremely early and extremely full. But still, if we look at the total amount of gas we will need in a year, this total amount is less than 23.8% of all the gas we will need to supply to European industry and simple people like me. So yes, we are full. Are we out of the problems? No, because nobody looks at the risk that the supply that we are getting right now, and look at Norway now, maintenance right now seems to take out 5.5 BCM of Norwegian gas. We are counting on the fact that the global market will supply us, and we are not realizing that that means 75% of the gas we will need in the next months, years, is needed to be imported from, well, trustworthy and trustworthy suppliers. So Russia, for sure. Qatar, also Algeria, it's an issue. Egypt, it's an issue. US LNG, yes, we are very thankful. And yes, we, as always, Europeans are very thankful to what the US is bringing us. But we also understand it's not up to President Biden where the LNG will go. It's up to the owners of the LNG. And if prices in Asia are up, or India or Pakistan or wherever, then most probably Americans are going to look at how much they can earn, and then maybe Europe is not anymore their top priority. So no, we are not yet out of the risks, and are there more risks than that Europeans or European politicians are willing to admit? Yes, there are, and no, they do not want to see it.
All right, thank you. And we'll come back to you. I'm going to want to move to Aziz and talk a little bit about offshore right now. So how do you currently assess global upstream activities in the current market? What are the industry conditions, and what is driving decision maker in offshore right now, being that we're seeing a lot of new offshore projects come online and a lot of blocks being auctioned off?
Thanks, Tracy, and thanks to everyone who's tuning in and listening in. Great question. To answer it to the best, this sector upstream is going through quite a historical period of time. And why I say this is because of many conditions that are casting their shadows over upstream as a sector of not only the oil and gas, but also on the macroeconomics. And the first element of the global scene for upstream is the risks. The risks are piling up in ways that have never been seen before. Risks include financial risks, access to capital, access to banking, access to investors, as well as regulations. Regulations that are imposing more windfall taxes, more regulations on what operation methods are being used, so on and so forth. And then there are the risks associated with the climate decarbonization, lower emission compliance, and what goes on with it, including flaring, methane, venting, all these requirements that are becoming a part of a risk assessment instead of preference of operators. Having said that, the second item that are casting their shadow over the upstream sector are the uncertainties. And let me make it very clear here, uncertainties are not risks. The difference between them is that risks are probable, and we use the probability matrix to predict them, whereas uncertainties, they're not really predictable, but they cast an even darker shadow over upstream. The third element that are being quite prominent on what happens with upstream is, of course, inflation. And the reason why I didn't say it was number one or number two is that inflation is part of the macros, and then it influences capex, costs, labor, and all of these together. And so inflation makes upstream more difficult for many reasons. Number one, the investment cycle in upstream is quite long. And most operators, including the integrated oil companies, they're not really able to shorten these investment cycles substantially or effectively to make it much shorter. That's just operation. That's just the nature of upstream. Now, number four, I would say on the global upstream scene is competition. And what we're seeing today is different than what we're seeing 5 years ago. The reason why I say this is competition is not becoming among the companies to deliver more or to take on more frontier areas. Instead, it's becoming a competition to reduce risks and tackle uncertainties. And that's a different form of competition than what we're used to in the industry and what we're used to in the markets. Number five, what we're noticing in upstream is that oil field services have a much bigger appetite to work on the carbon capture and storage project than they're willing to work on the drilling and workover and well services, oil field services. And that kind of makes the equation more complex for upstream. Number six, I would say, is the investment cycles are attracting investors. When it comes to shorter investment cycles, they're attracting more government players into longer investment cycles. What does that tell us? It tells us that if the government is not supportive of these projects, it becomes difficult. And given the current situation with the regulatory environments and what goes on with government interventions, all these influence directly what happens in upstream. I'll put it there, and maybe we can discuss more.
Yes, I still have. I wanted to talk a little bit about Guyana right now, since it seems to be all the rage. We've had big oil discoveries from majors such as XOM and TTE, and another round of blocks were just recently auctioned off a couple of weeks ago. So what do you expect from oil production, or what do you expect from these projects in terms of oil production? It's been said that this particular area is going to surpass U.S. offshore by 2023 as far as production is concerned. So can you talk a little bit about the Guyana projects?
Yeah, so frontier areas, including Guyana, Suriname, Namibia, West Africa in general, they're becoming such hot items because oil companies, operators are finding these areas a bit distant from the regulatory environment, but also quite promising given the volumes. What happens in Guyana is the pleasant, I guess, surprise that in the history of upstream, we don't really see a billion-barrel oil fields outside of the Middle East, Russia, or Brazil. And Guyana came in and made quite a pleasant surprise. And over the past 12 or 15 years, Guyana had gained quite a momentum in terms of operators, competitions, blocks, and the development of course, the Starbrook oil field, Liza, all these newer oil fields that are coming in stream. But would they be able to put up with the current demand, would they be able to fill in some gaps for future demand? That remains a function of more complex equation to solve. Guyana and Namibia, for example, are the hot cakes today of upstream. They are the hot items, not only because they're green fields, but also because of the volumetrics they've shown. I guess fields like Graf or Venice in Namibia might as well be just as attractive for operators as they are in Liza or the other Guyanese oil fields. It remains a question of how would the operators bring in their operation to bring those barrels from the subsurface to market. And it's only when these fields are quite developed. What we're noticing with Guyana is there is a reliance on the floating production, storage, and ships that are being used. Each of these ships is able to process up to 200,000 barrels a day. But the last we heard is that in Guyana there are 3 of these FPSO. Would they be able to develop platforms in the future for more permanent operations or not? Is the operator interested in going that extra step? We still don't know. But what we're noticing is there is a focus on the musical chair game that goes on with these blocks today, both in Namibia as well as in Guyana, given the potentials of these oil fields.
And do you think these fields are going to be enough to kind of keep answering current demand numbers? And what is the specific timeline for these to come online?
Oh, great question. Well, first of all, would they be able to keep up with the current demand? I don't think these fields, even though they are in the billion barrels in place oil fields, I don't think they would be able to fill in, even substituting for the natural decline of the current mega oil fields that are producing. Mind you, keeping up with future demand and future demand growth. And so it becomes more critical on how the operator deals with the market conditions and answering to the demands of the market. If for example, let's say Venice holds about 5 billion barrels, and the other field over in Namibia, Jonker, holds about 2.5 billion barrels. Production is estimated to be around maybe 150, 200,000 barrels a day, but that doesn't answer in a substantial way the demand expected. What really and that brings us to that greenfields today are incentivized by the integrated super majors, but the brownfields, these are the oil fields in Russia, the Middle East, particularly Saudi Arabia, UAE, Iraq, and Kurdistan, as well as the East Med and Australia, the Canadian oil sands. These brownfields would still hold potential value in answering the demand more than the greenfields. With the situation of the Brazilian oil fields and the North Sea being scrutinized by regulators and being always challenging to operate them, the reliance on brownfields become much bigger over the short term cycle. I'm talking here about 2 to 5 years until these green fields become more mature when it comes to production.
Excellent, thank you. And we'll come back to you. I want to move to Robert. I want to talk a little bit about Indian markets for a bit. You recently wrote a 3-piece article on this for Hill Tower. What do you see for an outlook on this market? What do you see as the strongest, what are, I should say, the strongest and weakest sectors? Is there a currency risk involved? And I'll stop there and and let you start answering before I ask any more questions on this.
Great, thanks, Tracy. Let me begin to answer your questions by sketching some of the macroeconomic dimensions which condition, of course, and influence how the equity markets develop. I think everyone knows that India has, been a growth market for some time. It will continue to be so literally for decades. I'll mention why in a few minutes. For example, from 2014 to 2022, the growth rate of the GDP was compounded, was 5%. The last 2 years, it's 5.2%. That's in US dollars. It's even higher in the local currency, rupees. It's strong and it's going to continue to be strong. The inflation has been relatively low, lately anyway, but it's expected to rise a bit, but not a terrible amount. The Indian economy and the markets suffered the same problems during the government-imposed lockdowns a couple of years ago, and they, however, roared back as the demand for goods and services increased higher than in some other places. Now, I think that they're going to remain volatile in the future, and nevertheless, during the current year, 2023, India is expected to account for about 1/6, 16% of total global growth. So that's really quite a bit. Because of the slowdown in Western economies that receive Indian exports, it's the domestic market, the industries with large domestic markets that are going to be more profitable in the near future. Those include capital goods, infrastructure, IT, automotive, also the real estate sector and the power sector and the healthcare sector, actually rather diverse, each for a different reason. There's an increasing amount of healthcare tourism in industry. Modi, the prime minister, is finally, after people have tried for decades before him, bringing electricity to the countryside. That's the power sector. It comes in, gets into the kinds of energy technologies that are going to be more popular in India. In the short to medium term, if you look at the chart, you have a long, very long-term ascending channel that in US dollars, if you look at the Sensex index, for example, in US dollars, it's running up against a resistance, which is and forming an ascending triangle. There's analysis of this in the Hill Tower piece that you mentioned. But in Indian rupees, it's still continuing to increase. So the consensus is that the Indian markets, speaking generally, will continue to rise only in the case of a further devaluation of the rupee against the dollar. Interestingly enough, the chart in this respect very closely resembles the Canadian market, not suggesting that the reasons are the same at all, but it's just interesting to observe. The Indian economy is going to profit in the near, medium, and longer term from the reshoring and the nearshoring, the reconfiguration of supply chains coming out of China, as well as due to the rising disposable incomes of Canadian consumers. And India will, in terms of those reconfiguration of supply chains, which, by the way, as you probably know, on the global level, are bifurcating between a US or an Anglosphere centric supply chain and a Sinosphere or China-centered supply chain. India is going to tend toward the US-centric because it's in its interest to do so, because it has the heritage of common law that all of the former members of the British Empire do, which, you know, includes all of those nice things like accounting law, insurance law, all of those regimes, as well as contract law, which, you know, is a little more touchy in China and places that follow a different legal system, even in Europe, which has civil code. They're not as geared to developing small enterprises. Now, that sort of summarizes in broad strokes the Indian macroeconomy, its place in the world economy, the equity charts, and some of the sectors. And I think that answers then most of what you asked me. Let me know if I left anything out.
No, I think, well, what do you think are the strongest and weakest sectors? In other words, if we are investors in India, which I know that there are quite a few on this stream as I'm looking through it, what
Yeah, that would be, can you still hear me?
Yeah. So what should investors?
Yeah, I'm back. I had to dump a phone call. Please go ahead.
Yeah,
Which sectors, right? You asked which sectors. Well, as I said, the ones that in the near and medium term are going to be the most profitable are the ones that are directed toward the domestic economy because of the anemia of the economy, of the Western economies to which exports are directed. So that would be capital goods, infrastructure, automotive, construction, and power, I would say. They're all, I would say maybe automotive a bit less than the others. Construction has been growing rapidly. IT is, you know, internationally known. That's never going to stop. And it also has a very, very significant domestic market. You might, the listeners also, they might want to look at the metals because the metals sector is one of the strongest performers. And of course, there's continuing strong global demand in that. If you really want to, you know, get down to the nitty gritty and you can hack it, you might want to look at the real estate sector. But again, to pick up one of your earlier points, there is a currency risk involved, and you have to be aware of that, and you have to evaluate that before you make any investment, if you're not investing in rupees, the local currency.
And then
Hello?
Can you hear yourself for a second? Hello?
I'm here.
Can you hear yourself for a second?
You want me to mute? Just a second, I will.
Hello? All right. Do I sound better now? Yes. All right. Mute yourself until I'm done talking. Robert, mute yourself. All right, just unmute yourself when I'm done talking because I'm having a cross current problem with your phone. So I wanted your thoughts on resource nationalism in India. For example, we did see a recent rice ban. So do you think that conditions are going to be that we were going to see more of this based on just geopolitical scarcity?
Well, yes and no. It's nothing new. India has been, on the high on the resource nationalism list for like the last 5 or 6 years. I think Malaysia and Thailand are up there too in Asia. So the rice ban got a lot of headlines, but it's nothing new. It's nothing really to be, concerned about. I mean, it's from a very, everyday standpoint, it's a good thing for India because that means that they'll have well-fed, healthy workers to make the economy grow. But I don't think that's anything to be, that there's not much beyond the headlines there, except perhaps, in the world agricultural markets, of course.
And then I'm going to just talk a little bit about India's energy security policy and what this means with regards to Russia and its relationship with the United States.
Yes, well, its relationship with the United States is going to continue to, there's going to be a continuing rapprochement, they're going to get closer strategically in the Quad and everything. As for energy in particular, you may be making an allusion to the fact that India has been importing a lot more Russian oil than they used to. The U.S. is winking at that. What India is doing with that is it's refining it and then it's exporting refined products. And so that's, good for India. The U.S. Doesn't want to offend India, showing some good sense as opposed to its northern neighbor, perhaps. So that I should mention that India imports about 85% of all the crude oil that it consumes, and Russia, and from 40 different countries. So, Russia is in the mix, and it may be importantly in the mix to a certain degree. But again, a lot of that is refined and then re-exported. And it's not like the Indian economy would sputter and fail without Russian oil. As for gas, I might as well mention that India produces about half of the natural gas that it consumes, and the rest it doesn't import any gas from pipelines. So the rest is from LNG, and a lot of it's from Cutler.
Excellent. Thank you.
I'm going to.
All right, perfect. Can everybody hear me? All right, perfect. So I want to move on to Warren, and we'll come back to Robert. Then I want to switch to U.S. markets here for a little bit. You just wrote an incredible thread on the S&P 500 being a very important juncture. Can you walk us through this? And I'll retweet your thread on Twitter so people can follow along.
Hey, okay, yeah, absolutely. I'm going to pull the thread up myself so that I can remember whatever I said. Yeah, I mean, basically, this is a dynamic we were pointing out for our clients within the markets, and so our I'd say we've done a pretty good job in Q3 through Q3 of navigating the backdrop, and so coming into the quarter, into the second half of the year, we were basically overweight commodities and max underweight bonds, more or less, with some leaving out all the details. But that was the trade we had on. In the middle there was equities exposure wise. And so we are kind of in the process of reversing the bond and commodity trade. We can talk about that. But, the natural next question, we have been running a maxed out cash position for our clients here as well. And I do think it's getting closer to the time where there are going to be opportunities to deploy that cash position. You don't want to be, it's been a great place to be, you get 5.5%, but you don't want to get stuck there. It's a recipe for underperformance, even though it is it does smooth out your volatility and things like that. But the world goes on, and you have to get out of cash. So we're considering equities. That we were looking at equities and whether it was time to get into them or increase our exposure further. And there's been a few things that are positive. Number one, we've seen earnings estimates for 2024 increase, which is nice. We haven't seen that coming out of any Q2, any quarter reporting going back to last year, really. So we go back to Q2 reporting last year, Q3, Q4, which was the beginning part of this year. Their forward estimates are either going down or flat. Now they're going back up. So that's a positive thing. So it caused us to re-examine the equity markets. And really what I've seen is as we came through Q2 earnings, most companies were beating earnings estimates but selling off. And to me, this is something you need to take note of. It's Jason Shapiro, I have to give him credit for coming up with this term. It's news failure, which I've seen this phenomenon plenty of times in my life, but I didn't have a label for it. But news failure, as I'm calling it here, is when you see, with regards to the equity market specifically, when you see a company come out and beat earnings and have a great quarter and then sell off. To me, that's a warning sign. And we saw that. I think the quintessential case for a news failure in the equity markets this quarter was NVIDIA. So NVIDIA came out, they blew the doors off earnings, they increased guidance, they initiated a buyback. Everything was better than the best possible expectation. And here we are, the stock's gone from 500 to the low 400s in the weeks since that earnings announcement. And so this kind of, I think, is the setup. This begs the question that the thread honestly was getting at, which is, where's leadership going to come from in Q4 if we are going to have this Q4 rally, which is kind of consensus, I'd say. It's the seasonal pattern. We get a down September. October's a good month. The rest of we have a Santa Claus rally. This is kind of the pattern of equity markets. And I think the question on my mind is what's going to lead. And we've seen the equal weighted S&P 500. So this was really the playbook coming off of Q2, was that the equal weighted S&P 500 started participating. It wasn't just these top 7 tech stocks. So equal weight S&P 500 had a great rally from early June into late through July. That's kind of broken down. We're now breaking down below support. The equal weighted S&P 500 is now at this very moment negative on the year. And so this is not a broad-based rally. Even though the S&P 500 is up something like 10% this year, equal weighted S&P 500 is negative for the year. And so it's really these huge mega cap stocks doing the work. And when you look at the charts of the mega cap stocks, let's go back to the NVIDIA story I just told. NVIDIA is challenging support levels. And it's tough to jump back into the NVIDIA boat when you just saw the best possible quarter you could have asked for as a bull and the stock sold off. So what's your upside? Maybe you can trade it here for a bounce or something, but are we going to break back above that 500? And what's going to take fundamentally to break that number? And my colleague, Fernando Vidal, put together, his background is in machine learning AI. He put together a really good, I think, report for our clients. And he was out in the media talking about it before the earnings report, basically saying that what is priced into NVIDIA through 2027 reflects a very unlikely future. So this goes back to NVIDIA's challenging support. It really needs to hold that support given what's happened in the equal weighted S&P 500. When you look at Apple, I see a similar kind of chart pattern. It's breaking down now. It's breaking down from what was support. You're seeing it break back below the last year's August highs, which I think is important support. So when you think about big cap tech being the leaders through the first part of this year, these two stocks represent 10% of the S&P 500, and the charts are pretty ugly here. And so that's a concern. And that's my question going into Q4 is where will leadership come from? The equal weighted S&P 500 is broken. I don't believe there's going to be this rotation. I think we're getting later in the economic cycle, and I don't believe the rotation is going to happen and that broadening is going to happen. So that puts the impetus back on big cap tech. I think if anything, you could see a big cap tech rally in Q4. But again, given what happened post earnings, I'm skeptical of that. And then finally, we looked at energy leadership in these in markets. And energy is one of the worst sectors where to get leadership within the market. It's historically the third worst sector for leadership. And as you get to the end of a cycle, we're going to have a soft landing or hard landing. Energy is an outperformer when the cycle ends with a hard landing or a recession. It's an underperformer when the cycle ends with a soft landing. And so this last 3 months, energy has destroyed the market. And I think that that's a negative sign. That's not internally to the market. You don't want to be banking on energy, as the leadership group. So the setup for Q4, I get the seasonal. I get that everybody really missed the bull run this year, or most people did. And that makes you eager to go in and buy the market here. I think that we have to the question I'm wondering is, can these charts in big cap tech hold out? Do we get a miracle rotation? I'm skeptical of that. So the big question for Q4 is, where will leadership come from? And I'm struggling to see really healthy leadership for a sustained bull market.
And then of course, I have to get your thoughts on the energy markets. Is this a higher for longer regime? And what does this do to the Fed's inflation fight? Are they kind of, stuck between a rock and a hard place with this 2%, or are they going to have to raise inflation targets?
Yeah, I don't really know what they're going to do with the inflation target. I think that there's a tendency for all of us in markets to kind of skip to the last chapter and not read the whole book. And to me, that's where a lot of this goes. And I like doing longer secular thought pieces, but it's important to distinguish between secular forces and cyclical forces. That's a secular question. I don't think there's any chance the Fed abandons their target in the near term. I think that would be devastating. Politically, it would be destabilizing at a societal level. Like, it's going to have to take place in some other way. If it does at another time in a different condition, and it's probably not going to be an overt change. And there's probably going to be some kind of pain, much more pain than we've had right now, on like the demand or growth side that the Fed induces in order to get them to raise their target. So that's kind of how I look out in the future and think about what's going to happen with the inflation target. I think that the indigestion within the equity market, yeah, we're getting cheaper on a PE basis, but as a relative trade, stocks are kind of treading water here, because even as they're falling and earnings estimates are ticking up next year, you're getting such a rapid move higher in the back end of the curve, which is where ultimately equities get priced. So think about the 10-year as your discount rate for equity markets. And obviously the 10-year is going up. Why is the 10-year going up? There are a bunch of reasons. These were all the reasons we were so underweight bonds coming into the second half of the year. The bottom line is that the Fed kind of brought all of those factors to a head in the last FOMC meeting, because they came out in their SEP, they backed out next year's cuts. They said we're going to have higher real rates next year. The way you interpret this as a market is that it doesn't matter if inflation comes down next year for just a little bit of time, the Fed is not going to cut rates based just off of a temporary dip in inflation. And honestly, I think a lot of the work we've done, that's what you need to have a soft landing. We call it a hyper-reactive Fed. If you look at soft landings, the Fed basically turns around when they hit peak rates for a cycle and starts cutting within a couple months. That's how a soft landing goes. That's the bet that's implied in equity market pricing right now. And I think the last SEP really shook the market up, shook the rate market up. There's a lot of supply that has to be digested by the bond market over the next quarter, and even more looking forward even. And so this rate dynamic is going to be with us for a bit. And in the stocks, you're either going to have to figure out how to get you to go up while rates also go up, or you're going to have to find a new level of pricing that makes sense for the S&P 500.
And which camp are you in? The soft landing, hard landing, or no landing?
I think there's going to be a hard landing. I think that We've said repeatedly, though, that the odds of a soft landing are greater than a lot of people want to acknowledge. We wrote a pretty long report on what are the ingredients of a soft landing earlier this year. We pegged the odds of a soft landing at like 25%. And I would say since that time, when I say all this stuff, it's probably going to sound like I'm a recession cheerleader, but in reality, I think the odds of a soft landing have increased, maybe from 25% to something more like 40%. So still odds are that we're going to have a recession and a hard landing. But the real question isn't, what's going to happen next. It's what's being priced in. And that's what I go back to, the stock market is already priced the soft landing in. So even if it's a 60% odds of a soft landing, I don't think those are good odds for what's priced into the stock market right now. And it maybe all works out. Maybe it works out for the equity investor, but as of right now, you're getting paid 5.5% in cash. You have a few alternatives. Even long bonds or 10-year, is at 4.5%, whereas it was sub 4% just a couple months ago. So there is an opportunity cost for betting on that soft landing too. The really just final point, because I don't want to monopolize the space, but like the final thing that we've been saying is because a soft landing is priced into markets, it puts more of a premium on assets that diversify in the event of a hard landing. And those assets, in our view, are really resource related. So I think that the smarter argument for being overweight energy here is not that oil is going to keep going higher. It's not that there's low PE ratios. It's that energy is doing things in your portfolio that really no other asset is doing. So you need to stay overweight energy. Gold is also one of those assets that falls into that bucket. So I think that's my quick overview.
And then just one other question till I move on. The U.S. government fiscal policy seems to be butting heads with monetary policy right now. So how is this affecting the Fed's job, but particularly going into an election year as, the Biden administration is going to try to stave off a recession?
Yeah, I think that fiscal policy has been the number one factor that has caused this cycle to be so different from other past cycles. And if you just looked at monetary policy, you expect, we've had the fastest rate hike cycle, steepest rate hike cycle, highest funds rate in X many years, yet we keep getting positive economic readings, and the economy is just like, it's hard to kill, and it's because of the fiscal impulse. You're seeing that in non-residential construction spending. You're seeing it in consumer checking accounts. It's really a powerful force, and it's one I think we've never seen before. Like, there's the stat I go through is we have never seen in American history deficits at 8.5% of GDP, while the unemployment rate's like 3.5%. That's a massive pro-cyclical deficit, and it's unprecedented. And so, to me, this is the number one wild card in the deck. Usually you see a deficit like the size we're running right now at the trough of a recession, and we are late cycle, while nominal GDP is ramping, and you still have this kind of a deficit. It's really uncharted territory for modern U.S. history. And so there's a huge forecast error that goes with that. And we don't know what's going to happen exactly. And we all have to kind of, I think, operate with max flexibility given that backdrop. I think still, though, our view is we watch the housing market. That's kind of our ground floor source of truth within the economy. I do think this is a consumer-led economy. I think that housing is really intricately tied to the consumer balance sheet. So as housing gets sick, the consumer catches a cold, and the entire economy gets hit. There are a lot of little subcomponents of that in the crowding out that takes place because of government spending that could change the way the cycle unfolds. But that's what we're watching is the housing market. We're watching we have our set of indicators for our hard landing scenario. It points to something in the first half, call it Q2 of next year, being the official recession start. But that's kind of a silly prediction to make. It's just that's what our model suggests. We rather have a good framework than a prediction, and so that's how we're handling that fiscal impulse that you're referencing.
Excellent. Thank you. Well, this hour has gone by much faster than I had thought. So the final round is the same question for everybody, and we'll go in the same order that we started. And we'll start with Cyril. Is what are you particularly paying attention to right now in markets, or over the next, say, 12 to 24 months, or you can talk about something that you wanted to cover that we just didn't get a chance to cover.
Okay, quickly then, of course, first of all is oil prices, because they are going up and everybody thinks or fears that it's gonna hit the $100 mark. I don't see it yet, so focus on that, because even that demand, etc., is up. There are some internal issues maybe inside of OPEC that can prevent it to break it. Second of all, energy prices in Europe, they will decide if we will be hitting a hard or a soft landing. At this moment, the count is still out, because Europe's economy is still doing much better than we thought. So unemployment is extremely low. So there is still some room. And third of all, and I think that's where the main focus is, what will be the effects of the stalling energy transition? Media is always hyping it. Hydrogen, green ammonia, etc. The USA with its IRA Act. Also, the results are much lower than we are expecting. So there are some huge bumps in the road that could break the wagon. And if that's gonna happen, what will that mean for oil, gas, and coal? And keep in mind, there are some new major investors in towns in metals and minings, and Aziz knows them also, but look at them. They are doing a lot more than that you're thinking. And if you want to look at stock markets, look at the multitude of IPOs that is happening or is going to happen in 2023, 24 in the GCC and MENA. It's going to be extremely interesting. Okay.
Thank you. And next, Abdulaziz, something that you wanted to cover that we weren't able to cover, or what should we be looking at in markets as investors over the next, say, 12 to 24 months?
So I would say primarily, while everybody is focusing on the prices of oil and gas, the actual focus that people should be paying attention to is the supply, particularly how the unwinding of storages globally are actually affecting markets and how they're playing out in predicting where this market is going. Another element that I think is just as critical and just as important on a global front is how the U.S. foreign policy drives through these conditions that are actually influencing the macros, as well as influencing the inflation numbers. How people are paying attention to the Fed decisions are are all good, but at the same time, the actual commodity markets have their say, and the sentiments that are associated with commodities would have their influence not only on the energy markets, but over the overall inflation numbers, in my opinion. So pay close attention to that. Thank you.
Next, and thank you very much. And Robert, the same question, something that you wanted to cover that we didn't get a chance to cover, what should we as investors be looking at over the next 12 to 24 months?
Yes, well, I think that as has been said, the energy sector deserves definite attention. And I had articles on the Hill Tower site, one on Equinor and another one on Petrobras. I'll just mention that that the gas supply also is going to be, we haven't talked as much about gas as about oil this hour perhaps, but it's going to continue to be very tight. The head of marketing from Equinor believes that the tightness in the global gas market is going to persist for at least another 4 years. And prolonged, there will be shortage of supply. A field goes down for maintenance and it's going to cause volatility in the price, which didn't used to be the case. Also, Petrobras, I think, is just worth mentioning. The head of E&P at Petrobras came out with a statement at the same news conference where they announced we're going to have this offshore wind in Brazil. They said, oh, by the way, we're going to be heavily involved in oil and gas for the next 40 years. That's 4 decades for the next 40 years. And I think that's an indication. Equinor also has wind generation, but what is lost in the shuffle is a lot of the time, especially for Equinor, this wind generated energy is used to run the electricity on their oil and gas platforms. It doesn't go to consumers onshore, and they still get credit for constructing so-called renewable technology energy. So I think that the energy sector, natural gas, and Equinor, Petrobras, which I had articles on, and a few other things. So that sort of wraps up, what I didn't have the chance to cover because we talked so much about India, which I was also very happy to do.
Well, thank you very much. Can you mute? Sorry. Oh, sorry. I don't know why I'm having an issue with cross current with your phone. But thank you very much. And we'll definitely have you on again to talk about some more things. Don't worry. And then, Warren, your final thoughts, something you wanted to talk about that we didn't get to talk about, or, what should we as investors really be focusing on the next 12 to 24 months?
I would say I have so many different things I could say, but really my mind is thinking about how assets move together or don't move together as kind of a portfolio construction idea. And everyone knows the 60/40 is, there's been a lot of noise about 60/40 changing, which I'm part of that. I believe that it has. The beginning part of this year, we saw 60/40 rally, and I saw a lot of people come back and say, oh, 60/40 is back. It was never dead, blah, blah, blah. And I think the problem there is you saw stocks and bonds rally together. Now we're seeing stocks and bonds fall together. I'm looking for if that correlation flips at any point. When does that correlation flip? Here we are again today. Stocks are fading and bonds are continuing to sell off, and we're getting new yield highs. It looks like across the curve. And so I think if you get a rally in order to get a rally in the stock market in Q4, I think you need to have a rally in the bond market. I think these things are still attached to the hip. So I'm watching that correlation, and I'm watching how these assets move together.
Excellent. Thank you. And last but not least, I want to call up swing pony shop. It's going to talk a little bit about what we have going on at Place Your Trades on Friday.
Hi, everyone. Shy, great panel as always. We have end of month, end of quarter coming up. It's right around the corner, and we all know that there's some really, really massive moves that come into the close. So I wanted to jump in here and tell you guys about a really fun competition we're hosting on Friday. It's called the Predict the Close Challenge. So you can click on the link that Shy has posted in the nest, or just go to placeyourtrades.com/challenge to learn more about it and sign up. So essentially, it's a simulated futures trading challenge. Each person is going to get $100 in virtual purchasing buying power to compete for the top 3 spots on the leaderboard. The objective is to have the highest account value by the end of the day. And we have up to $1,000 that we're doing in giveaways to the top 3 winners. So it's going to be a lot of fun. It's going to be the last 2 hours of the day on Friday. We'll be hosting a live spaces here on Place Your Trades. It's going to be me, Shy Girl, Anthony Crudele, Pax, Anne Marie, Jake Wajastic, and Shark as well. And we'll actually be competing in the challenge too. So it's going to be a lot of fun. Come see how you rank in the leaderboard, get a chance to win. And we're excited. So if you want to join us, just go to placeyourtrades.com/challenge. It's totally free to sign up. And I think it's going to be a really fun way to close the month.
Thank you. And with that, I want to thank all of our guests for taking time out of their day. I know you guys are really busy. I know our audience certainly appreciates it very much. And please follow everybody that is up here. They all post really great information. Follow Place Your Trades so that you know the upcoming events that we have. And with that, I will see everybody next Wednesday. Again, thank you so much, everyone, for taking time out of your day today.
Thanks, Tracy. Thanks, everyone.